Hello, everyone, again. Investors, both near and wide. Welcome back to Money Talks
with the Wealth Whisperer.
Welcome, Matthew.
Thanks for having me on, Rob. Excited to be here.
It's great to have you here.
Yeah.
To everybody out there, today what we're going to be discussing, as you know, we had a little bit of a preparation, and that was around, honestly, everybody, this is going to run the gamut from the most basic to specifically a couple of tax strategies that you can employ from an investing standpoint that, when implemented and monitored, will make a magnificent difference in the after-tax money on your investments. To get to this, we can't really have this discussion without talking about how we got to the fact that there's such a thing called as registrations. Okay? For today's discussion, which probably makes up 99.8% of all registrations that there are, we're going to discuss brokerage accounts, which would simply just be known as after-tax accounts. We're going to discuss IRAs and 401ks, traditional on a pre-tax basis, and Roth. Okay? So prior to 60 years ago, there wasn't a discussion of multitude or multiple registrations. There was, I invested money in a brokerage account and I buy and sold stocks. And the taxation was, I had dividends, I could have a capital gain, and Congress would constantly change what those rates were. The 401k, I think it was maybe 1982 is when the 401k came into being. And initially, and for most of its history, has just been pre-tax. And then recently, the Roth. I guess a great place to start is to tell us a little bit about, the differentiation. And like I said before, the basics of investing. Because I go back, and leading into the question, is every time that I have a client that comes to me and says, I got my kids in college, or my kid's just graduated from college, he's making a great amount of money, more than he could ever possibly spend his entire life. I need you to help him. Would you be willing to meet with him? All right. I learned early in my career that when you're meeting with somebody who really is green and new to investing, you better start by explaining what a registration is. Because I think we all in this industry have heard the jokes. Is my first job at Fidelity is I answered the phone, and people would call in and they would be asking about investments, and it was my job to help them. And the question that you often got is, what does your IRA pay? Okay? And so we would all laugh because IRA is a registration, and what is it pay has to do with the investment within. So from a taxation standpoint, Matt, we've been doing this for a long time. Can you talk to us a little bit about, and once again, Matt Ringel is the managing partner of DLAC Wealth Advisor. And for most of his young career, I would have considered him my protege.
Yeah, thanks, Rob. Appreciate the introduction and having me on here. If we're going to start with the basics of registrations, I'll just start at the point of which Rob did, which was talking about brokerage accounts or after-tax accounts. As he said and alluded to, those accounts are where you take after-tax money, so money you already paid taxes on through your paycheck or whatever it was, and then you invested it. You put it into an account. And then that account, the money that you put into it on an after-tax basis is actually never taxed again. What we're being taxed on is the growth in that account. And that's where the government comes in and the IRS comes in and changes those tax rates all the time. But you only have to worry about that on the growth of the account. And then they invented, like you said, the pre-tax IRA or the 401k really. And that allowed individuals to start investing their money on a tax-deferred basis. So it allowed them to actually go in, put their money from their paycheck into this vehicle and not pay taxes up front.
If anybody remembers, just to take back, if we have any people that, like me, can date themselves, people were obsessive in the 80s and early 90s. And actually, the tax code was a little bit different. And so people put all sorts of after-tax money into IRAs just so they can get the deferral.
Yep.
And then that's when you had your products start to come into play through the tax code and annuities. But Yeah, we'll talk briefly to that today.
Yeah, that's where all those tax sheltered annuities and all those things started to come into play. And then, so that was your pre-tax IRA, your 401k. And then about late 90s, I think it was, they came up with the Roth IRA.
It was.
And that was what allowed people the ability to say, hey, I actually want to go ahead and pay the taxes today, but still like that tax deferment of growth. And so that was the Roth, is you could put your money in, you could pay the taxes first, put it into the registration or the Roth IRA, allow it to grow tax deferred. And actually, if you meet certain requirements, it's tax-free when you go to pull it out on the back end.
And Matt's right. For those of you who don't know, there was a Roth IRA well before there was ever a Roth 401k. Roth 401k, it had 2003, 4, 5, 6, 7, 8, somewhere in there. And it took many, many years for most companies to even allow the Roth component or feature to be permitted in their company's 401k.
Yeah.
Matt and I are pretty obsessive as it comes to taxes. And with the multiple meetings that we have with our high net worth clients every year, I'd say upwards of 25% of the time that we spend in these meetings is actually spent on taxes. Because I really love to focus my attention on statistics and probabilities. With statistics and probabilities, black and white is pretty easy. And a lot of investing, with statistics and probabilities, you're just trying to get things in your favor, okay? So when I talk about us being obsessive, I'm not talking about deferring taxes. I'm talking about saving taxes. Mm-hmm. What will my taxes look like today and for the rest of my life? And if I do something today, next year, or the year after, why is it better than doing something else? Okay? But that being said, most investment professionals, and that's one of the reasons why I love to have these, because there are some people, I always talk about time, desire, and wherewithal. And for those of you who are listening today, if you have the time, if you have the desire, and if you have the wherewithal is what the podcasts are about, where I'm going to give you 20-minute, 30-minute discussions where it's not overly complex. And as you'll see today, if you implement the strategy, because you got the time and the desire to do such, we're going to give you the wherewithal. All right? So the laziness of the industry and most professionals are, always in any company, it's always about, how much time is I'm putting in and how much money will I make? Well, here's what we know about a lot of investment professionals. They don't want to put in a lot of time and they want to make a lot of money. So what is it that they talk about, and why would they want to all understand? It's a big lie, so be careful.
Yeah, well, I mean, they speak about what you already covered, Rob, which is they talk avoiding taxes in a legal way as tax deferment. Okay. And they mix the two together. And they say, well, if we defer the taxes, it's as good as saving you money. Like you said, that's a big lie. That's not. You're going to eventually pay those taxes. What we do here, and I think why we go above and beyond at DLAC, is the ability to look at not only the client situation today, but the client situation into the future. Mm-hmm. And that's where we really get out of this game of deferring taxes. And we talk more in the realistic of when should we pay these taxes, mm-hmm. right? And that becomes, should we pay them today versus should we pay them in the future?
And as I said before, if you have the time, desire, and we'll teach you wherewithal, it doesn't matter what we're doing. We're going to teach you to be able to do what we do.
Yeah, and so a lot of the industry will go about, saving their time while making their money is they'll sell you a product. Oh, it's tax deferred. It'll be great. You'll be in retirement. You'll pay less taxes on it. That's not always the case. We find clients sometimes are in unique situations or maybe making less money today than they are going to be in the future. Or we even consider what could happen from a governmental standpoint of raising taxes in the future. You might be better off to pay them today instead of deferring them to the future. And that's really where our personalization and our going above and beyond from a working standpoint actually saves people actual dollars instead of just acting like they're going to or possibly might.
Yeah. We've both heard we talked about deferral before, the Roth conversion, so you try to, hook someone in, give them a free dinner, and ultimately they're going to try to sell them something that has very little to do with a Roth conversion in the first place.
Yeah, pretty much. That's how unfortunate most of the industry works.
I started implementing registration analysis and security positioning, Matt, you were in grade school. But I really have appreciated the way that you've embraced the concept. And we want to make this for the audience as simplistic as possible. Can you just start us off with the basics?
Yeah, so let's dive in. Instead of talking theory with registrations, let's actually now start talking about investments, right? And let's just say that there's this word I'm going to make up called stocks that are out there. This
crazy word,
yeah, and an even crazier word called bonds. Bonds,
okay.
Right? And what we're going to say is hypothetically, with stocks, we're going to make 9% per year. And bonds are going to make 3%.
Boo.
Okay? And when I set this up, what I'm going to do, Rob, is I'm going to force you to put half your money in stocks, and the other half has to be in this thing called bonds.
Okay, you don't have to force me to put in stock, but those, okay, you're going to force me those bonds.
Force you to those bonds. That's what we're going to do. And then I'm going to tell you, based upon these registrations, you got one that's going to let you keep all your money, which is the Roth after taxes, and then you got one that's going to maybe let you keep 60% of your money after the government has their hand in it. If I put this scenario out there for you, the unwanted partner, and if I put this out there, which one would you, Rob, hold your bonds in versus your stocks in? Which registration?
Since I'm not a huge fan of the IRS, I'll let them get 60 cents on the dollar of 3%. To help with our discussion today, I brought a couple of visuals. Let me set the discussion. Let me just say that I have two hypothetical investors. One, his name is Mr. Investor A. Okay? The second is Mrs. Investor B. Great names. They may even be related. I'm just not sure. Yeah. Okay? Well, each individual, as the example you were giving me previously, each of these individuals has $1 million. Okay. They have both predetermined that they wish and they feel appropriate to have half of their money in the stock market. And with half of their money, they really want to keep it safe. So whether it's bonds, fixed CDs, whatever it is, they put their safe money, half of it is what they feel comfortable allocating there. All right. So Mr. Investor A, as you'll see, what I have here, put 50% of his pre-tax IRA or 401k into stocks and 50% into bonds. That's why, as you can see in that particular column that is being highlighted right now, 0.06 means 6% per year, straight line return, 25 years. Okay? Mr. Investor A has a Roth account, also with $500,000. He also has that allocated at 50-50. Once again, if you're using an advisor, they're very likely investing like Mr. Investor A. I've been doing this for 30 plus years, and outside of maybe our organization, I don't really know anybody else who does this, although I feel it's relatively simple. Once again, it'll take a little bit of time, a little bit of knowledge, and a little bit, knowledge and wherewithal being the same. So Mr. Investor A, once again, his Roth is allocated 50% in stocks, 50% in bonds, and that's why for 25 years, you see 0.06, okay? 0.06 equaling 6%. So over 25 years, if they're holding exactly 50% in this, let's call this hypothetical investment SPY, and 50% hypothetical investment in AGG, so they have the same exact investment, and the returns, like we said, are 9 and 3. Their gross returns will take the $500,000. Let me just take a look myself, cheat a little, and it'll take it to 2.145 or $2.146 million approximately. Okay? So what then happens is the Roth, you get to keep all of it, you get to spend all of it. The IRA, in this example, we said between federal, state, local, all taxes combined, 28%. So Mr. Investor A actually gets to spend, as you see, $1.545 million from the money that they invested as Investor A. All right, now I'm going to talk to you about somebody really smart. A relative, but must be really a distant relative of Mr. Investor A, and that's Mrs. Investor B. And she's a whole lot smarter than him, okay? Mrs. Investor B has $500,000 in pre-tax and $500,000 in post-tax Roth. Here's what she did instead. She took her pre-tax money and put it 100% in bonds. She put 100% of her Roth into stocks. She got the returns that we shared. Stocks did 9, bonds did 3. After 25 years, and to understand we're not cheating here, what this would actually involve, if these investors always remained 50-50. Obviously, if one asset class is doing 9 and the other's doing 3, you'd end up being massively overweighted in stocks, and then you'd be cheating. So what we did here is we actually said that Mrs. Investor B, in her Roth, she does slowly get allocated to bonds over time. So what's in her Roth is not so much more than is in her traditional IRA. Okay? So in this particular example, Mrs. Investor B, after 25 years and only paying 28% tax on the money that made 3%, from the IRA has approximately $754,000 of spendable money. The Roth, $3.25 million. Mrs. Investor B, who had the same exact accounts, same exact positions in the same exact dollar amounts, somehow has more than $300,000 more than Mr. Investor A. Pretty cool stuff. I hope everybody is proud of their work ethic and the value of work that they put in. So I want to talk a little bit now about 2 things. One is a process and one is a tool, okay? And the process is something that I've embraced in terms of management responsibilities that I've had before, and whether that's managing people or whether that's managing processes. And what I mean by that is baseline and then benchmarking, okay? So we're going to take that and we're going to incorporate it into the tool that I'm now going to have you look at. Within this tool, we call it our allocation tab. And so what we spoke to today, one of the first things that you would do is you'd be like, okay, I got 2 different accounts, or I have 10 different accounts. And those accounts are going to range from different registrations. So as we noted, it could be taxable, which is going to be like a brokerage account, is what we call it. It could be pre-tax or deferred, or it could be post or Roth. All right. So in essence, what you want to do is hierarchy these. And what I mean by that is if you're a long-term investor, it's very, very, very likely, but no guarantees. You know, past performance is not a guarantee of future results. If I have to remind you all. But over long term, stocks are likely going to do better than what bonds are going to do. You know, right now, as the taping of this, I'm thinking the 10-year Treasury bond yields about 4.1%. Okay. Stocks still for the past 100 years have done near 10. They may not be able to replicate that, but that's another discussion. You know, chances are they'll do better than 4%. We're going to hope. I wouldn't want to know what the world looks like if they're not able to do 4% over the next 25 or 30 years.
Exactly.
Okay. So on the tool, as you can see, you can put in each account that you have. Maybe you put bank accounts, CD, Roth IRA at XYZ Investment Corporation, 401k at work, rollover from a prior pre-tax, a rollover from pre-tax contributions in an old job that I had. Okay, so as you can see, as I'm saying this, you're going in and you have to say, okay, this is a Roth, this is a pre-tax, or this is a taxable account or brokerage account. Hierarchy, all right? Roths is where you want to have a majority of your stocks for your long-term investing, okay? Pre-tax is where you want to have most of your bonds in for a long-term investor. Well, guys, you haven't talked about brokerage accounts. Brokerage accounts are sort of, they're in between. You know, hopefully you're using something very tax efficient in your after-tax accounts. So you're not incurring unwanted capital gains. You can control your capital gains. If you're holding a stock or an ETF, you know, a passive ETF or a passive mutual fund, then your capital gains should, in essence, be non-existent unless you're causing them. Okay? You're going to have dividends. It's very likely on whether it be your stocks or ETFs, and you're going to have to pay taxes. There's nothing you can do about it. Okay? So there still is a law today known as a step-up in basis. I'm not going to have a full explanation, but step-up in basis says this. A lot of people listening today, and a lot of my clients, and hopefully myself, when I do pass away, I'm not going to be destitute and broke. Hopefully I'm going to have some money. I'm going to leave some money behind. You know,
Your kids would appreciate that.
Yes, and one of the best places to leave behind is highly appreciated stock or ETFs. Because what would happen is, at least hypothetically, 40 years in the past, someone buys a stock or ETF at 10 and they pass away and it's at 100 and there's $90 of capital gains to be paid. You pass away in a taxable account. Doesn't say you placed beneficiaries on the account through a TOD, or it's a revocable trust. That's another whole discussion, but to keep it simplistic, we'll just say an after-tax account. They're going to step up in basis. And if they were to sell it the day after they inherit it from you, the only taxes they're going to pay is the difference from the day that you passed away to the next day when they sell it. All the other taxes are forgiven. So that's the reason why after-tax accounts, or what we'll call taxable accounts in this tool, you'd probably have more stocks in it than you would have. I mean, let's be honest. The largest investable asset by far that an investor is going to have when they retire is going to be their 401k. All right, I've been doing this forever. It's, you know, I don't have the statistics in front of me, but absolutely, investable dollars are mostly there. So, but if you have some Roth and you have some taxable accounts, this should work rather well for you.
Yeah, Rob. So you're talking about baseline versus benchmarking. If there's anything that I've come to know in my 10 years of experience being within this industry, is organization is key. If you can't be organized, probably not going to be successful. Can't say that definitely, but I know in this industry, it's pretty hard to be successful without being organized.
I'd say in life.
I'd say, and that's fair. I think that's absolutely fair.
You probably can get through life without being organized, but you're probably not going to be too successful.
That's right. Yeah. And so what we're talking about here is really organization, right? You've given us the baseline, okay? Filling out the allocation tab, putting the investments in the right registration to start off. Now let's talk a little bit more about the benchmarking aspect of it. The benchmarking aspect of it is being organized enough to go in at future points and making sure your allocation's not out of whack. Now, I'm not talking about the need to obsess over it and go in every week and make sure your allocation is, you know, being corrected. That's a little obsessive, and I don't think that that's really going to provide you much value. What we're talking about...
We both know that people do add or pull money out.
Yeah.
Or place trades.
That's true.
Yeah, and they may not always swap a stock for a stock or a bond for a bond, I guess.
Yeah, and I think that happens fair enough with time. But the big one's going to be, and what you alluded to earlier, is the growth of that 9% bucket that we named stocks versus the growth in the bucket of bonds or the risk-free investment that's around 3%. Over time, as we showed in our example, if you're making 9% from an investment, you're going to become out of whack, right? The stocks are going to grow much more than the bonds. You're going to end up being more stock heavy in your portfolio. So there is a need to think about the benchmarking aspect. And that's saying, you know, whatever it is, whatever you use, the calendar on the wall. I don't think people use paper calendars anymore, but you set your reminder on your computer or your Microsoft Outlook calendar, whatever it is.
The word in this industry is tickle.
Tickle it out. Tickle it out. There you go. You want to tickle yourself out a reminder, probably, you know, every couple years. You know, every few years, I think you want to come back in and you want to redo your baseline exercise. You want to say, where am I at now? And where should I kind of reallocate those to be, you know, going forward? Yeah,
I guess what's also happens is always want to reinforce, even though it would normally not be in today's discussion, is the remember buy low and sell high. Okay, it's still the number one rule in investing. You know, momentum is good, and it's worked magnificently and never worked better than it has, in that we're on just this 15-year run where we've had a lot of volatility, but the trend has been obsessively up. So yeah, you're going to have to not only look at this tool, but you're also going to have to say, hey, what's the allocation across all my money, right?
Yeah. Oh, yeah, absolutely.
Matt, let's talk trading. I'm not going to blame people, because I could see there's reasons why they do what they do around this, and they're real reasons, but I want to be an educator here. And I want to tell them the pitfalls of doing what most people do. You know, so I want you to talk a little bit about, where do people mostly hold cash? And I'm talking cash even above and beyond their checking and savings account. Let's call checking what I need from day to day, and let's call savings the money that I need to use in the next 18 months for projects that may come up or significant purchases that I'm trying to save towards. So I want you to talk a little bit about where people hold too much cash and why it's in the wrong place, and trading. Where do people trade and why is that the wrong place to be trading?
Rob, that's a great question. And I think this is very prevalent for what's going on today, right? Because a lot of people are holding that cash, to be honest with you, they're holding it mainly in brokerage accounts. Now, those after-tax accounts we were talking about, and they've been enjoying these 4 or 5% returns in their high yield savings account or their Vanguard or Fidelity money market or whatever it is. The problem is when you hold that cash in that account, like we said earlier, you're going to be paying taxes on that interest that's coming in from that account. And if you're what kind
of tax are you paying? Capital gain rate 15% or less?
No, you're paying income rates on that. So if you're one of these high net worth clients that we're used to dealing with, you're coming in and you're paying 28, 35, 37% maybe even taxes on the interest that you're earning. If you would have instead held an investment like that or the cash in your 401k or your pre-tax IRA account, you're not going to have any of the interest income being taxed at those higher rates. That's all going to be tax deferred, right? And I think this is the same problem that we see when it comes to trading. Unfortunately, a lot of people will have that cash in the bank. They'll stick it in their brokerage account. And then, what we say, they just start banging away trades, right? They just start going at it, buying and selling, buying and selling. Problem is, you buy and sell in a brokerage account, those could possibly be taxable events, right?
Where should they be trading?
They should be trading in the 401k and the IRA. Because
how about the Roth?
Well, in the Roth too.
Okay.
Whether it's a pre-tax 401k or it's an IRA, Roth IRA, those types of registrations don't have taxes associated with transactions.
No.
So buying and selling all day long in those accounts, great, do it. That's going to be fine. You're not going to cause yourself taxes. You do it in the brokerage account, you're going to deal things with like interest income, dividends, short-term capital gains, which can be taxed at regular income rates. There's going to be a lot of issues when you try to actively trade in that after-tax brokerage account. It is not tax efficient.
As I just referenced, for the most part, where should you almost never be trading?
In the brokerage account. You should really try and put that money to work and sit it and forget it, is what the industry says. And then if you're going to go in and look at a 401k, that's where you want to be doing your rebalancing, or your Roth IRA, you want to go in there and rebalance. The